3i, which is the stock and company that you and I were surprised to learn not terribly long ago, is the best performing FTSE 100 stock over the last 10 years. At the point I said that, it was true. Since then, a couple of Johnny-come-latelys into the FTSE 100 have actually kind of barged past it a bit. But if we think of companies that have been around for quite some time in that index, 3i is up about 700 or so percent over the last 10 years, which is more than outperforming. I mean, that's good by any standard. That's good by S&P standards. And it's a private equity firm. It fell 7% earlier this week after it reported its update for what is essentially Q1 2025. And just as it did when it reported its previous news as well, the thing immediately, it fell, 7%, which is not a trivial amount, not much in the context of a 700% gain, but it then sort of bounced back again and finished the day down about 2%. And I was saying to you, this thing does dip, but outside of a kind of big market crash, ignore sort of the Liberation Day stuff. This is a stock that does look like it sort of dips and then people immediately think, no, we don't want to sell this. We're coming back to this thing straight away. It doesn't dip for its own reasons, put it that way. It dips if everything dips. But interesting stuff. So what happened in this trading update? Because look, before I said, I really like this company, but it's tough after a 700% rise. Actually, I don't think the numbers look crazy, but it's just difficult to see at the moment. So here's what happened. As a reminder, this thing has a private equity portfolio that is 58% invested in. Its largest holding, is a roughly 58% stake in a discount retailer based in Amsterdam, but operates across Europe, called Action. So we're looking at this retailer, and that's been an outstanding investment for the last sort of 10 years or so. It's grown like an absolute weed, and they actually price it relatively punchy on their balance sheet. But like-for-like sales, that number again that I talk about every time we talk about retailers, and I insist with some justification for doing so, were up 6.8%, which is higher than any FTSE 100 retailer I can think of in terms of like-for-like sales in the last quarter or even the one before that. So that's kind of a good and impressive results, but it is much lower than they were in the previous year. In 2024, like-for-like sales were growing at 10 or so percent, or slightly more than 10%, in fact, for Action. So like the other retailers, it's seeing like-for-like growth slowing quite a bit. And the number they carry it on their balance sheet at attracts a bit of criticism for being quite a punchy number. They carry it at a multiple of 18.5 times EBITDA, so 58% stake in this thing, but they value the whole thing at 18.5 times EBITDA. That's high for a retailer. It's really high for a retailer. B&M, for context, I tried to work out their price to EBITDA. JD Sports, I also tried as well. I got to around 3 in both cases. So you're talking about a massively higher multiple, albeit for a company that isn't reporting declining same-store sales, which both of those two companies are. So justified, by any sense, justified premium, justified that much of a premium there for you to decide. Costco, by the way, for context, which is the kind of, I guess, king of discount retailers and king of expensive discount retailers as well in terms of a stock, that trades about 35 times EBITDA. So that's we're not in that sort of territory yet. It's not a kind of one-off valuation that says this thing is a complete unicorn, but it is a valuation that says this is better than most retailers. And in fairness, putting up like-for-like growth better than most retailers for the time being. Anyway, slowing like-for-like sales growth is what I thought, and I haven't actually read other people's views on this, the main reason this stock went down, because it's a big part of their portfolio. They bought more of it last year, and if you're valuing at that kind of multiple, you should probably fear a write-down if growth starts slowing down too much. That said, 3i's big strength is still intact. Their big strength over the last 10 years has been that they don't invest outside of money. So the problem with private equity firms is that people want to invest when they can see results coming through, but that means it's because prices have been going higher, and that means they end up buying when things are pretty much near the top, and then they get worried when things get near the bottom because stuff isn't working and they want to rotate into something else, so they sell when things are low. And the trouble is, as Terry Smith has said before, and it's about the only thing he said that I really pay attention to, that's the trouble with being a kind of private equity firm or running a fund. The money shows up at the wrong times. When you start saying, guys, we're down 15% this year, great time to be buying, right? Suddenly no one wants to know. But 3i gets around this problem, and they've been getting around this problem for the last 10 years, and the rest, as they say, has been history, basically. It's around the point that they started switching to this model that their share price has taken off and their returns have kind of taken off. They achieved this year in 2024 a 25% what I would call return on equity. They call it return on shareholders' funds, but I can't work out what the difference between the two is, to be honest. Shareholders' funds appear to be basically assets minus liabilities, which is the same thing as equity in this case. So I thought the dip was kind of interesting here, Steve. It's less than 2 times book and 25% return on equity. That number doesn't imply huge amounts of growth built in here. And at the moment, you're not seeing huge amounts of growth. It is a historically relatively high price to book ratio over the last 10 years for this company, but I wonder whether it still doesn't look like crazy value. Once again, I deliberate on this thing and wonder whether my brief window for opportunity for buying this stock was at the, 15 minutes when it was 7% down, or whether I should still be looking. What do you think?
Yeah, it's tough, isn't it? I think, so you say the 58% share of Action. So that stake in Action is now 17.83 billion in pounds. And the group's total portfolio in this report is about 23.5 billion. So it's almost 75% Action, this company. So there's quite a lot of concentration risk here if you believe that Action's going to all of a sudden start to stumble. It's a bit like buying, I guess, sort of 75% of B&M European value with sort of like a little private equity arm. But the issue you've got here is that and why that's poor thinking is because Action's actually a fantastic business and is growing really, really well. The 3i portfolio has pretty much no relevance to the upcoming US tariffs. This is an overwhelmingly domestic European focused company. Little hints in this portfolio, Steve, potentially that they know this Action is a little bit maybe on the top side of their portfolio. They're really keen to talk about all of the other things that they've been either buying or some of the other businesses that are doing quite well for 3i at the moment. And some of them are giving 22 million of cash to 3i. Probably doesn't deserve a place on the top of the list on the private equity returns section. So maybe a little bit. But there's they've just bought Water Wipes, which is obviously a brand that I would assume you've come across, Steve, in your time. It's a segment leader. They've just bought a company called Constellation, which do managed IT services, and they've bought another company in Germany called Proof Service, which is a specialized testing service provider. Those three acquisitions come to just over 315 million quid. So again, not massive in comparison to Action, but they're trying, Steve, to bring it down. I think the problem you have here is that Action is such a fantastic business, and 3i keeps buying more of it through, I assume, reinvested dividends and things like that. That it's becoming a bigger and bigger part of the stake because Action's such a fantastic business, not the actions of 3i. If you were to value this on a traditional sort of fund value, Steve, which I would suggest is not good and not a good way of doing it, you're looking at like a 65% premium at the moment. That's quite a lot, but I would urge you to think that that's not the best way of valuing this. I think when you're thinking about this business, you're looking at constituent parts more than it, just looking at it as a fund. And yeah, I feel like this is the same way that I think I did before, Steve. That I think Action is a fantastic business. I think it's probably, if it was span out, Steve, and maybe that's where they could eventually end with it when they want to recoup the money if they can come across something worth having. It would be a business to consider, but I think 3i are quite happy just to milk this business now, let it get even bigger and bigger part, and when that growth finally slows down, then maybe start to spin it out. It's still growing, Steve, at like 17% a year, which for anybody who's looked at any kind of retailer in this sort of UK and EU, that's fast. for such a well-known company. So yeah, like for like sales growth, Steve, as you said, about 6.8% it says here, 427 million in cash on the balance sheet, and building about 76 stores in the last period. Um, I'm That's accelerated as well. There was only 64 in the period before, looking at my notes. So, yeah, Steve, I think let this one run. I'm not sure I'd be buying it here. I don't know if we're maybe a little bit anchored, Steve, to previous prices, but on Liberation Day, you must have been scratching around for cash, I would imagine.
I was too busy looking at Bunzel, I think, on Liberation Day, but that was busy having problems of its own. I was looking at everything on Liberation Day. It's an interesting one, isn't it? This is very much what. There's a slightly lazy comparison for this company to Associated British Foods in the sense that both of them have as their kind of chief asset a good discount retailer. Primark has lost its way a little bit recently in terms of sales growth and so on, but it is, by most standards, it's a good discount retailer, right? And ABF are currently going in a direction of getting rid of other bits of their business, which is to say, they're kind of undiversifying. They're getting rid of their sugar business at the moment. And I have long expressed the view of thinking I wouldn't mind if they got rid of all the damn bits of their business and just continue to operate Primark, which would basically take them back to being something approaching a 3i. They're not a private equity firm the way that 3i are. So the comparison isn't perfect here. But if you think, oh, there's a good discount retailer that I like the look of, the only way I can go buy it is by investing through in ABF in this case, or 3i. Which would you rather be? I think I'd rather be the concentrated one, to be honest. I would like ABF a lot more if it were to start dumping off some of the brands that I think are less impressive. And yes, they do add diversification. This point is true. And with Primark faltering recently, actually diversification is kind of welcome, and you see that in the short term. But to your point, we sort of complain about concentration risk in a portfolio, and I have two thoughts about that. One is the thought that you expressed, that if they'd been diversified with a whole bunch of other things, the stock wouldn't be up 700% in the last 10 years. It's done well because it's been driven higher by action, and it hasn't had that strong performance diluted down by other things. The other is, I don't love these arguments about portfolios like this being kind of undiversified. I feel like you can diversify your own portfolio if you're worried about it. I kind of think this feels to me a bit like complaining that all Greggs does is run bakeries, basically, and think, well, what happens if the bakery industry goes wrong? Not great for Greggs, but I'm not thinking Greggs should go and open car manufacturing arm as well or something. So in case there's a downturn in or inflation hits food prices or whatever. So I'm okay with the concentration thought here, and I'd rather be 3i sided than ABF sided. But yeah, I will keep an eye on this one. I think I have been keeping an eye on this one, and I saw it dip very briefly, and then I saw it undip again. But we will see what happens. It does look like the general market sentiment appears to be pretty positive about this, right? People want to buy this thing rather than not wanting to, I think, and that makes it slightly challenging from my side. But we'll see, as we're fond of saying on this show. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.